Okay. All right, Colette, we're good to go? Thank you, and good morning, everyone, and welcome to our 2021 Fall Inland Northwest Partners webinar. I'm Paul Kimmel. I'm Regional Business Manager for Avista and currently Board Chairman of the Inland Northwest Partners. I'd like to welcome all of you to our 2021 Fall webinar, and this is really it's one of my favorites. It's a highlight of the year. It's our Regional Economic Outlook, a post-pandemic recovery. We'll spend the first hour today hearing from Sam Wolkenauer, Regional Economist with the Idaho Department of Labor, and Grant Forsyth, Chief Economist with Avista. They'll both be sharing their perspectives about the impacts the pandemic has had and will continue to have on our labor markets in the North Idaho and Eastern Washington. And then we're going to transition into one of our fan favorites. No offense, Grant and Sam, you guys are fan favorites too, but we'll feature economist John Mitchell, and he'll be presenting the 2021 Regional Economic Outlook. And just to remind you all of our presentations from our speakers today will be available and posted on our website at www.inp.org under the Resource Center tab. So it's important for all of you to remember how we are supported, our sponsors and investors and members. And I want to just thank you all. The services we provide would not be possible without this financial support. To date, we have 14 investors, as highlighted, as you can see on that slide in front of you. And we'd like to thank all those organizations for their continued support of the Inland Northwest Partners. It's been an interesting 18 months, as we'll soon hear, and we do appreciate your continued support as we try to navigate through this interesting time. We'd also like to extend a special thanks to the University of Idaho Extension, Colette and Mackenzie, for their technical assistance, again, facilitating the webinar. And I'd like to introduce Colette DePhelps with U of I Extension, and she's just going to take you all through some quick technology tips and Q&A instructions. So Colette, thank you.
Hey, you're very welcome. Good morning, everyone. I think some of us might be getting back into our Zoom webinar shoes. So just a couple of quick things. If you do close the other programs running on your computer, it is going to dedicate your bandwidth to this webinar. If at any time you're having problem with sound, you can switch from the computer to the phone, and you can do that by using the call-in number in your welcome email. Please type your questions for speakers into the Q&A box that is in the control bar, usually found at the bottom of your screen. That is the easiest way for us to keep track of your questions. Myself and Mackenzie are standing by for any technical issues you might have. So for instance, if your sound seems to be failing, you can type into the chat and ask, is this my sound or is this the speaker's sound? If we lose a speaker, please bear with us. Sometimes bandwidth is a little bit shaky. We will get that person right back online. Again, welcome and thank you for being with us this morning.
And thanks, Colette. And again, on the slide here is our agenda for the day. And so let's get started. It's now my pleasure to introduce our first presenters. As I mentioned earlier, we're pleased to have with us both Sam Wolkenauer, Regional Economist with the Idaho Department of Labor, as well as Grant Forsyth, Chief Economist at the Avista Corporation. They're going to share information about the Inland Northwest labor market, the trends, challenges, and projections. So please join me in welcoming both Sam and Grant. And Sam, we're going to start with you, followed by Grant, and then we'll have a joint Q&A after both of your presentations. So thank you, Sam.
Okay, thank you for the kind introduction. I'm going to share my screen with everybody. It's not a particularly easy task because what I essentially am going to try to do is recap one of the most bizarre and, from an economic perspective, certainly traumatic years that we've ever had in, maybe 25 minutes, but we're going to do our best. So I'm going to dispense with the pleasantries, and I'm also going to save time by assuming that you have all heard of the virus. Because if you haven't heard of COVID, none of this content is going to make any sense. You can Google it if you haven't, and I also congratulate you on successfully evading cable news for 18 months. So let's just launch into this. I like to start right off the top by showing what is essentially the best overall indicator of economic health, and that's not the unemployment rate, surprisingly, even though that tends to be the headline number that people look at. We just kind of want to look at total payrolls. So this is what it looks like here in Idaho. This is total payrolls in the state. I'm going to show Northern Idaho in a moment, but for now we'll look at the total state numbers. And it's not supposed to look like this. You're not supposed to get losses that severe that quickly. If you go back to the housing crisis, which was the last major recession that we had, job losses were strung out over more than a calendar year. In this case, they happened all in the span of 1 month. So probably the easiest way to contextualize this is to note that the state of Idaho, at least, went from an all-time low unemployment rate to an all-time high unemployment rate in back-to-back months. And that happened right around March, April of 2020. So, we lost roughly 10% of our payroll in 1 month in the state of Idaho. And it was not immediately clear how this was going to play out over the summer, but we were quite surprised to see that in Idaho, at least, we were getting these jobs back really quickly and payroll was recovering at a very rapid pace. So that by the end of the year, we had essentially recovered all these jobs that we lost. And throughout 2021, we have returned to this path of growth. So it's a very weird recession. You have the biggest and fastest job losses that we've ever seen. Right? So this should be unbelievably traumatic from an economic perspective, lots of scarring, massive job losses, and then it all comes roaring back almost instantaneously, on an economic time scale. So normally recessions are very long and strung out. They're multi-year affairs. In this case, we had a whopping 2-month recession, right? So that's extremely strange. These graphs are not supposed to look like this, but we'll take it. This is an absolutely stellar performance for the state of Idaho. And I'm going to contextualize for you in a moment just how well the state of Idaho has done. For now, let's look at Northern Idaho. So this is all 10 of the northern counties. So essentially the entire panhandle. And you can see similar, just astonishing job losses. So if we're looking at this from a time perspective, in 1 month in 2020, so basically April of 2020 takes out all the jobs that we had gained since 2012. So they all disappear, and then they all come back just as quickly. So this is not the normal experience. That's the thing that we want to highlight, is that Idaho's rapid rebound is very abnormal. The dip is perfectly normal. Essentially every state in the country experienced a hard crash like this. Nobody bounced back like this, and that's what I want to show you. So one way to look at this is compare the payroll recovery in Idaho with the rest of the country. So you can see Idaho has returned to the growth path. I put this in percentage terms so we can get a kind of direct one-on-one comparison. You can see that Idaho has returned to the growth path. So, we're up about 4% at this point. The rest of the country still missing lots of jobs. It's been a much more sluggish recovery for other states. But my favorite way to look at this is with this somewhat overwhelming graph, but I think that this really puts it in perspective. So each bar here is a state. And what I'm showing you is the level of payrolls compared to the pre-COVID peak. So at last count, we have 50 states in this country, and 46 of them are still down on jobs. You can see that in Hawaii and New York, it's especially severe. For obvious reasons. I mean, Hawaii is just so dependent on tourism that all these travel disruptions have been really catastrophic for them. Nevada is another state that's down there at the bottom. And then you only have 4 states that have recovered. And these 4 states are North Dakota, Utah, Montana, and Idaho. And Idaho is the top bar. So Idaho has gained 4% on its payroll on top of where we were pre-COVID. Second place is Utah at only 1%. And then 46 out of the 50 states are still down. They're still trying to struggle back to the break-even point. So this really kind of puts in perspective how unique the experience here in Idaho has been with how rapid our jobs recovery has been. So this is absolutely atypical. And it's, you know, it's definitely a reason to celebrate, although we are aware that, you know, there are lots of reports about hospital capacity and things like that in Idaho. So we don't want to pretend that this is a story that is over, that the door has been shut on this. But from a jobs perspective, Idaho has been doing very, very well, and we should be pleased with this economic performance. So another way to look at this is to look at the number of unemployment claims in Idaho. And I realize that this is a petty complaint because lots of people lost their jobs or were hospitalized or passed away. But I'm going to be petty here for a moment because as an economist, COVID has permanently ruined our graphs, okay? Because we had to move the axis up to unimaginable proportions, right? So these are unemployment claims in Idaho, and you know, for 10 years, they never were higher than 20,000. And then overnight, they spiked to 140,000. So it just looks weird. It's not supposed to look like this. And it reflects that what happened in Idaho last year really was not an organic economic event. We were really dealing with something that superseded the economy, and it produces very unnatural patterns. So unemployment claims explode. Right? We expect this when you see job losses on this scale, but again, you don't expect this spike to happen in the course of a couple of weeks. And then as people get back to work, they crater off. And this was really astonishing to us. We really did not expect this over the summer. And as the claims kept trickling down, we're kind of monitoring it as it comes in and wondering, is this sustainable? Are we going to get a second bounce, sort of a double dip recession? But it never happened. They just kept coming down. And so by the time our governor ended participation in the federal unemployment programs, claims in Idaho were back down to normal levels already. So from an unemployment perspective, the crisis in Idaho was over at the beginning of this year. And you can compare this again to what happened to the rest of the country. So this shows you the spike in unemployment claims. Blue is Idaho, black is the United States. And you can see that the spike is pretty similar. So there's a point where these lines are essentially intersecting in late April of 2020. But then something interesting happens. First off, the spike continues to progress nationally, whereas in Idaho, it kind of flatlines and bounces around in a certain range there before it begins to crater. So nationally, at the end of the year, you still had roughly 8 times as many people claiming unemployment as there were before COVID. So this was still severely elevated, a massive unemployment crisis. Well, by the end of 2020 in Idaho, most people had gone back to work. And then the remainder trickle off of unemployment and get back to work over the spring months of this year. And then this graph is discontinued in April because Idaho stops participating in the expanded program. So you no longer have a direct comparison. And again, this just highlights that Idaho's performance has been very unique. I would say essentially singular among all the states. Nobody else has been able to match Idaho's performance in getting people back to work. And so we, you know, there's always an impulse to look at this and try to find what's wrong with it, right? Because we never want to believe really good news, probably because we're all jaded in the year 2021, but we want to know what's wrong with this. What's the catch? And we were certainly thinking that way over last summer, waiting for a double dip, waiting for the other shoe to drop. And we just kept churning out jobs, getting people back to work and dropping people off the unemployment rolls. And it proved very sustainable over the spring months. So we should feel good about this in the state of Idaho. Excellent year of job creation. And we ended up plus 4% year over year. Now, 4% job growth would be a really good number in a normal year when you didn't have a pandemic, when you didn't have mass layoffs in the spring. So the fact that we were able to reach that number is really quite astonishing. I'm going to kind of pivot now to talking a little bit about the labor shortage and the labor force. You're all aware, I'm sure, that there are serious issues nationally and especially in Idaho with labor availability. There was some new data that came out from the federal government showing that the number of vacant jobs and job openings in this country is now at an all-time high. There's something like 10 million unfilled jobs nationally. In Idaho, it's very straightforward though. We simply do not have enough warm bodies to fill all the positions. So here in Idaho, we have roughly 20,000 unemployed people, and we have something like 4 times that number of unfilled jobs. So at a certain point, when you're dealing with a ratio like that, you're basically playing musical chairs with employees, right? There simply aren't enough people to fill all the positions. So the labor shortage in Idaho is a manifestation of pretty brute force mathematics. There's 4 times as many open jobs as there are job seekers. And if my math holds, and I'm pretty sure it does, that means 3 out of those 4 jobs simply cannot be filled with the available manpower that we have. And one result of this is that you get more labor mobility. So it kind of is not something that you would intuitively go to look at, but the number of people quitting their jobs is actually a really good indicator of labor market strength, because a quit is a voluntary departure. It's also different from retirement. A quit means you voluntarily leave your job and then you stay in the labor force, meaning you go to another job. And obviously you don't quit your job when the economy is bad and you don't have good prospects of finding a new job. So when there are lots of people quitting, that's actually a really good indicator that the labor market is strong, workers know they have options and they're exploring those options. And the number of people quitting skyrocketed after we kind of got over that initial COVID dip and it reached all-time highs. So this is a really good indicator that the labor market is strong. Another thing that we can look at is wage growth. And I put this in here and I included retail and leisure and hospitality because these are traditionally lower wage industries that often have more sluggish wage growth. And what you can see here is that wage growth started to spike midway through 2020 as employers were trying to get people to come back to work, trying to fill these vacancies as the economy reopened. And you end up with new highs for wage growth. So normally wage growth has been running down around 2%. So basically keeping up with inflation. And then over the latter half of 2020, it starts to spike up to 5 and even 6%. So this again is just an indicator that the labor market is very strong and employers are having to bid each other up to attract labor to fill all their openings. So if there's a silver lining to the labor shortage, it's that it is good for workers. And really, we're very comfortable with language like buyer's market or seller's market when it comes to housing. That's pretty common language to hear. But I think that increasingly we need to be comfortable using that language for workers and labor. And right now it is a seller's market, because in the labor market, the seller of labor is the worker. He sells his labor to the employer, and it's a seller's market. And just like in housing, there is a supply and demand dynamic going on here, and it results in higher prices. And the price of labor is wages, essentially, is how we would conceive of this. Another way to look at this is rather than by looking at industry, we can look at percentile. So here in Idaho, you can see this upward trend where 2020 gets you new highs for wage growth. But what's interesting here is that the 25th percentile is actually growing faster than the median, quite a bit faster, in fact. So that means that wage growth is fastest right now for lower wage workers, which is kind of counterintuitive, not really what we're used to seeing, not really how we normally conceive of the labor market, but that's what the data is showing us, is that wage growth is actually higher for lower wage workers. So that is the silver lining of a labor shortage, is that it is a really good way to get higher wages and get better outcomes for workers. So we are definitely in a situation where tight labor markets have returned in a really big way. Now I'm going to kind of dovetail here and just comment briefly that labor markets in the United States have not been really truly tight in several decades. And there's lots of ways that we can kind of support this with the data. The labor's share of GDP is shrinking over time. Wage growth has been flat. These are kind of esoteric statistics that are more interesting to economists than they are to the public. But we'll just briefly comment, a tight labor market, we've kind of forgotten what that's like. And in a really tight labor market, if you can't bring people from application to hired in a week, you're going to lose them to someone else. And in a really tight labor market, if you aren't handing out really generous raises, a lot of your workforce just spontaneously quits and goes to work for someone else. And in a tight labor market, people take job offers and offer sheets and they go to their existing employer and they just get a huge raise because their employer can't afford to lose them because they know they can't replace them. These are kind of the on the ground manifestations of a tight labor market. And Idaho is definitely returning to those kinds of conditions. And that's why we're seeing all sorts of innovative strategies from employers trying to attract people. You see hiring bonuses, you see flexible scheduling. We've even got some companies that are looking at going to a 4-day work week. So on the ground, it's definitely tight in a way that matches what we're seeing in the data. And so that's just a manifestation of our demographics and an economy that's running very hot right now and is struggling to find enough workers. So on that note, I'm going to pivot and talk about demographics. So I'm going to start by showing you what population growth has been like over the last 10 years for Idaho, and then I'll show you our projection for the coming 10 years. So this is population growth chopped up by age group. And you can see that the bulk of the growth, by far the fastest growing cohort here, is the 65 and older crowd. I had a question posed to me in a fairly blunt way recently asking if, from a demographic perspective, Idaho is Florida North. And if you look at the growth of the retiree population, that is kind of an inescapable conclusion. Although fortunately, we don't have all the Florida man headlines yet. Those are always fun. So maybe Idaho man will start to make an appearance and we'll complete our transformation into North Florida. But for now, it's mainly on the demographic side that this is manifesting itself. So the 65 and older crowd is what is driving our population growth. And we don't think that this is really going to shift. So this graph is essentially the same thing, but this is our forward projection. So you can see that we think that the 65 and older age group is going to continue to be the driving force. By the way, when you see that the 45 to 64 population is projected to shrink nationally, that's not because of people dying. That is because eventually all of the baby boomers will have aged into the 65 and older. And at that point, Gen X is simply not large enough to offset them. So the net size of that second to last age group begins to shrink, just to clarify what's going on there. So Idaho, our population continues to be driven by retirees, and this has some important ramifications. Number one, this drives the labor shortage, right? Because retirees are consumers, right? They drive business from a demand side, but they don't contribute to the labor supply. And I don't mean that to suggest that they're freeloading. I mean, they've certainly earned retirement, but you end up with this essentially brute force of mathematics where you have a ratio of consumers to workers that is growing more and more lopsided. So this drives labor shortages. The second ramification of this, though, has to do with housing. And so that's the last thing I'm going to talk about before I hand it off to hear about Washington. I would be remiss if I did not talk about housing. Okay, so this is home prices in Idaho, and I chopped it up by tercile. Now, a tercile is just a third. And every time I see this slide, I think I should just change that to third because tercile sounds so So, pedantic and arrogant, to use a weird word like that. So just put third in there. I guess I thought I was fancy when I typed that out. So we chop this up by third, and the reason I do this is to show you that every strata of the housing market in Idaho is just exploding. So you're looking at almost 30% price appreciation year over year, and this holds for all segments of the housing market. So we know that home prices in Idaho are kind of running out of control. And so the question is, what's going on here? Well, it turns out that COVID had a pretty big impact on the housing market in the United States and in Idaho. So I want to explain how this worked. When COVID started, we originally hoped that it would free up a lot of professionals to move to Idaho and work remotely. We thought that you would get permanent full-time telework and people would move to Idaho because they could keep working for their existing employer, but they could take advantage of lower congestion and lower prices in Idaho. That's not what happened. And the reason is most companies that have gone to permanent telework are doing so on a hybrid basis, meaning they're only teleworking a few days a week. But that still has a really big implication. So let me explain. When you get hybrid teleworking, like let's say you only have to go into the office 1 day a week, this allows for high income workers to live in more remote suburbs from their job site. So if you work, we'll just pick on Amazon because everybody picks on Amazon. If you're a programmer or an engineer for Amazon and you had to be in the office 5 days a week, you probably want to live pretty close to HQ because we all know what commutes are like over in Puget Sound. Well, suddenly you only have to go in once a week for meetings, right? So 4 days a week you can work from home. Well, if you only have to go in once a week, suddenly a long commute isn't that big of a deal because you're not making it daily. So hybrid teleworking has emancipated a lot of high income workers in the big urban areas. It has freed them up to live in more outlying suburbs where they have a longer commute, but that they're only making it once or twice a week. So if you look at the epicenter of the housing market in America and where prices are going up, it's actually the suburbs of the big cities. So what's happening is hybrid teleworking is freeing up these workers to move out to the outlying suburbs. And when they do that, they cash out the people that have been living there who are predominantly retirees. So you have this chain reaction, this kind of ripple effect from telework, where high income workers vacate the dense urban cores. If you look at apartment vacancies in the really dense urban areas, they're very high right now. So people are leaving the dense urban cores, they're moving out to the suburbs, and then they allow retirees to leave those suburbs to sell and move to places like Idaho. So the net implication of COVID was actually to just intensify the pattern that we've seen in Idaho of retirees moving to the state. We are picking up some people who are able to telework full-time and are able to move to Idaho, but by and large, retirees continue to be the driving force of population growth in Idaho. So we were quickly disabused of any notion that COVID and teleworking was going to slow down immigration to Idaho. Our housing market actually accelerated, in-migration and population growth accelerated. So it's very unique that even though COVID was a sort of rare economic disaster in terms of how fast the job losses mounted and so on, for Idaho, it was an accelerant. And this is a huge reason that A, homes continue to be very expensive here and are rising daily, and B, our economy has recovered very quickly because there's a continued influx of high income retirees that are able to drive business, drive the recovery. So we continue to be a high activity, high desirability state. So the last thing that I want to mention before I move on, because people always want to know, why isn't there enough housing? And it turns out that this is not an overly complicated question. Turns out there's not enough houses because we didn't build enough houses. So it takes a really smart person to figure this one out, that the supply of something is directly related to how much of it you make. Go figure. So this is home construction in the United States. This is new homes built per 100,000 population. So it's kind of like a per capita new home construction series. And you can see that this is on a downward trend. It's cyclical, obviously, construction cycles with the economy, but you can see that every peak is lower than the last. Every trough is lower than the last. So it's cycling and spiraling downwards. So a good way to think about this is that even at the height of what we thought of as a housing bubble in 2008, when it seemed like the market was going crazy and there was construction everywhere, even at that point in time, we were building, about a third less on a per capita basis than we were in the 1970s and the 1980s. So over time, over a long period of time, construction in the United States has been softening and there's been less home construction. There are a lot of reasons for this that I don't have time to go into, zoning and preferences and things like that. But the point is that we're kind of paying for it right now in terms of first-time home buyer affordability. I would also like to point out that the housing crisis in 2008 was particularly poorly timed, because this happened right as millennials were making career choices. This was a very formative event for millennials who saw this growing up. And it turns out it's really hard to convince young people to go into construction when they've gone through a big housing crash and seen construction workers go on mass unemployment. So we end up with this perennial shortage of tradesmen, because it was very difficult to convince millennials to go into the construction trades. So we're paying for this on the back end, in the sense that A, we don't have enough housing, and B, we can't bring new housing online fast enough because we have this really at all levels of the supply chain. We have severe shortages of skilled labor, framers, plumbers, electricians, HVAC, on and on throughout the process of building a home. There's not enough skilled labor. So this is kind of the long view. We started on the short end looking at COVID, looking at things that have happened really in the space of a year. And then we're kind of concluding by looking more at some generational issues and some long-term issues with housing and migration and demographics. So hopefully this can kind of present a full-bodied look at what's going on in Idaho. It is a very high growth state. We're very pleased with the job growth numbers that we were able to clock over the last year. But we do have challenges. There are challenges everywhere. And in Idaho, housing supply continues to be one of our largest challenges. So if we could sum up what happened in Idaho, it's that we recovered very quickly, and now we're defined by a shortage of two important things: workers and homes. And so resolving those shortages continues to be the main challenge going forward for Idaho. So with that, I will hand it off to Dr. Forsyth, and we'll hear about Washington, and then we're going to do a joint Q&A at the end.
Right. Thank you, Samuel. So I will go ahead and share my screen here. So hopefully everybody can see that. So, and hopefully everybody can hear me. So I'm going to talk about the Eastern Washington labor market. And actually some of the themes that Sam has talked about are going to resonate here. I do have a little bit different track I'm going to take, but again, a lot of what we're seeing in Eastern Washington is what we're seeing in Idaho. But I will say that Idaho has in fact recovered probably more robustly than Eastern Washington. But we're also going to talk about why the data is maybe not showing the full recovery in Eastern Washington. And it's sort of an interesting story. So let's go ahead and talk about that, looking at this first slide. And so what this graph shows is it's an index of employment. Everything is indexed to February 2020. And we're looking at really the employment level, employment behavior indexed to February 2020. So the index is 100 over the roughly 20 months of the pandemic period. And what it shows is kind of how employment behaved as we moved through the pandemic. So the dotted line there that you see is the US. The blue line is what I call the rural county ring. It's Adams, Ferry, Garfield, Grant, and Lincoln combined together. That gold line is the Pullman-Clarkston region, kind of a semi-metro area that's Whitman and Asotin counties. And remember, Asotin is actually part of the Lewiston-Clarkston metro area. And then we have the Spokane metropolitan statistical area, which is Spokane, Stevens, and Pend Oreille combined. Okay. The first thing to note is that we actually performed somewhat better than the US as a whole when we slipped into the worst part of the pandemic, right? A little bit of good news there. But what you see, right, if you look at, the region in Eastern Washington, is that we're still below that index level of 100, meaning we haven't yet fully recovered. But one of the things that I think it's important to think about, and I talked to Doug Tweedy about that, and this is Sam's counterpart in Washington for the Employment Security Department, is that when we look at the recovery, one of the things that we've noticed is that we have some job growth that's not reflected in these numbers. And so, for example, if you look at the Spokane MSA, we're still officially about 3% below where we were in February 2020. But as it turns out, Amazon, the jobs that Amazon has brought to the Spokane metro area, and they brought in quite a few, are not actually reflected in the metro level data. Apparently, Amazon does not provide their data on a county level. They provide it at a state level, so it's reflected at the state level. But what that means is that we're undercounting in some of these counties the amount of employment that's actually occurred as we have recovered from the COVID-induced recession, right? And if you add in an estimate of the Amazon jobs, especially in the Spokane metro area, you're actually almost back, or essentially back, to that pre-COVID level. Doug Tweedy also pointed out to me that remote workers, so for example, let's say you work for F5 Networks in Seattle, right? That's your home base, but you're working remotely in Spokane now. You may not actually be counted in the Spokane data. So one of the issues I have gauging the recovery, right, is that maybe the recovery looks a little bit stronger than what the official data says, because we're not necessarily recording all of the jobs that are actually occurring in the recovery in the counties that I'm showing you here. But even with that, what the data clearly shows is the recovery in Eastern Washington has not been nearly as strong as what we've seen in North Idaho. Now, I think it's also useful when we talk about the jobs recovery, it's also interesting to talk about what are the skills that are currently in demand. Now, the Employment Security Department collects some really interesting data now on Washington State, and they go through basically several different private entities, a company called Burning Glass, the US Conference Board, and Help Wanted Online. And what they do is they collect data by county on the most requested skills through online wanted ads. And by doing this, we get a sense of what are employers really demanding as we get into the recovery period, post-COVID induced recession. Now, what they do then is they have this online search that goes on. They look at broad skill levels, like for example, they'll be looking at IT. From that broad category, they look at specific skills, for example, Microsoft Office and productivity tools. That is in fact a specific skill that employers often ask for. And from there, you can do a frequency count of how often are these broad categories showing up, by which frequency, and within those broad categories, what is the most common specific skill that's being asked for. And so I put this together for all the counties that we've seen. So it's Adams, Asotin, Columbia, Ferry, Garfield, Grant, Lincoln, Pend Oreille, Stevens, Spokane, and Whitman counties. And that's what you see there in the table. It's an accumulation by broad skill area. And so we can see, which broad skill area shows up the most. And so what you can see is the top 5 skill areas account for really about 70% of the specific skills requested. And of course, at the top, we've got healthcare. And within that healthcare category, we're seeing a lot of demand in all counties for basic patient care and an emergency and intensive care, which shouldn't be a surprise, right? But keep in mind, even before the COVID pandemic, it was the case that healthcare was really the dominant source of demand by employers, by county. Next, we have administration, and that's people who can perform scheduling activities. Okay, again, in the top 5 there, we've got customer support, basic customer service, sales, general sales, but under the IT category, we have Microsoft Office and productivity tools. Right. Now, I remember, when I was a college professor, I always told my students that if you can't handle Microsoft Office, if you can't use Excel and you can't use Word, you're going to be in big trouble in the labor market. And it turns out that is true, because pretty consistently, right, within help wanted ads online, that's often a requirement that employers are looking for. But again, pretty clearly, as we think about the recovery, one of the dominant places that employers are focused on is this healthcare sector. I want to go down a little bit. You can see, if you go down just a hair to supply chain and logistics, that's a big issue these days, because supply chain and logistics have been upset by COVID. And you can see that the primary specific skill they're looking for is material handling. Of course, some of that is being influenced by the growing role of Amazon in the region. But again, healthcare seems to be where a lot of the action is. Okay, so far, everything we've been talking about has really been focused on non-farm employment, non-farm help wanted. Okay, we also need to talk a little bit about the farm sector, though, because in this recovery process, the farm sector is struggling from the beginning, because the lockdowns were a little bit hard on farming. They had some problems adapting to social distancing, meeting the requirements that the state was imposing on all employers. But in particular, one of the things that's hurt farming, especially this last year, has been that heat dome. And so when we think about the farm sector, they're really kind of getting a double whack. One is trying to adapt to a COVID working environment, but the second one is this heat dome has seriously damaged the wheat crop in the Palouse region. And in particular, this slide is from the USDA, but I actually pulled the slide based on an analysis done by the Washington Association of Wheat Growers. And really what we're seeing is that they have about a 30% decline in production this year with respect to white wheat. Okay. Not only that, this is going to greatly impact their ability to export, because they have much less to export. And also, even if they even had a better year than what they had, in other words, we didn't have the heat dome, farming, because they export most of their production overseas, we're still struggling globally with the ports, the ability to move product from one location to another, even within the United States, and certainly problems moving it from the United States to overseas. So again, the farm sector has been dealing with a lot of different struggles, okay, right? And the heat dome and the destruction of the crops is just adding to some of their woes that were already in place because of the COVID-induced recession. And so even though they're not a large employer in terms of direct farm employment, this is important because they're a major income earner for the region. And this is something that's going to act as a bit of a drag as we try to recover again from the COVID-induced recession. Now, I want to spend a little bit of time talking about this, and this gets to some issues that Sam raised about demographics. Okay? And this is population growth for 2021. They are estimates from the Office of Financial Management, so they're the most updated estimates we've got. And you see two measures for each county. The blue bar is the total population growth in 2021. The red bar is the population growth you would have observed if you only had natural growth. And what that means is that essentially that's the difference between births and deaths. Okay. Now, I want to point out just Whitman for a minute. If you look at Whitman County as a real outlier, you know, the COVID recession caused a big outflow of students that have their residence in Whitman County. So you can see the population growth is minus 5%. Right? Whitman County is a real outlier. And one of the things that surprised me, as I think Sam was mentioning, was how little COVID reduced in-migration to the region. I mean, if you look at other parts of the world that were doing lockdowns because of COVID, internal migration essentially came to a stop. This was certainly the case in China. But in the United States, Americans continued to move around quite rapidly, and we certainly benefited from that. And so if you consider the US population growth rate is something like 0.3, 0.35%, we're actually growing much rapidly in this region, in Eastern Washington, than the US as a whole, right? So you can see, you know, in most cases, 1% or higher. But it's almost entirely due to people moving here. And so if you were to have only population growth dependent on births exceeding deaths, we would actually have, by and large, in a lot of counties, negative population growth. And that just simply reflects demographic trends and the fact that people are just having fewer children. So you have an aging population, you have people choosing to have fewer children. And so in the absence of that in-migration, our population situation would look vastly different, right? And that's what that graph shows. But it just, again, I just want to highlight how unique this situation has been. And I agree with Sam, is the pandemic has not slowed in-migration to the region. And we see very robust population growth and all the economic issues and problems that come with that. Now, this is the same graph, but we're looking over, again, a longer period of time. And this, again, is just important because, you know, your population growth and what's happening to your population is really going to have a large impact on what your labor force looks like. Not just the number of people you have to work, but what their age demographics look like. And again, what we're seeing, again, you know, even in the long term, is how dependent the region's population growth has been on in-migration. And should that in-migration come to a halt, we're going to have a very different looking population growth going forward. And so what I just try to constantly remind my colleagues at Avista, I try to remind people who are elected officials that this population growth that's generating so much economic activity, right, is highly dependent again on people moving here. When that stops or that slows, you will notice a pretty significant change in the population growth rate. And for some counties, it means essentially negative growth over the long run. And so with that, we'll go ahead. I think we're going to do a question and answer period here with Sam and I before we move on to John Mitchell.
Yeah, thanks, Grant and Sam. Great questions. I've got a couple questions, so let me tee this up, and I think this is for both of you. The question is, what do you see as the overall impact of a shortage in labor in the service sector, particularly restaurants and lodging, and especially in tourism-dependent communities?
Well, you know, that's sort of a tough question. I mean, it's a tough thing to answer because if that sector has had a business model that was always dependent on relatively low wages, I think you're going to have a problem with that business model going forward. And so it might be the case that people in the provision of leisure and hospitality services, if they don't have the ability to meet the new wage levels and they can't really adjust their business model to meet those, my guess is you might start to see some exits out of that industry as, as owners of firms decide to do something else with their capital because they simply can't adjust their business model to those higher wages.
Thanks, Grant. Any thoughts, Sam?
Well, I mean, the classical response that you would expect is higher wages and higher prices. That's how you adapt. But like Dr. Forsyth said, there's a limit to how far you can go with that before your business model gets distorted.
Thanks. And Sam, this is a question for you. One of your earlier slides had to do, I think it was with, it showed all 50 states in that that horizontal bar graph chart.
Yeah.
I think it was wage recovery. The question was, where did California fall in that slide?
Sure. Yeah, I saw that question in the chat. I looked this up. California, their payrolls were down about 6%. So this is number of employees. And so that's kind of right in the meat of the graph. They're right in the bulk in the middle, I would say.
Okay, thank you. And maybe this is for both, but since Grant, you touched on wheat production and kind of our ag industry. This question is with respect to the decline in wheat and dryland crop production. Most producers will have had crop insurance to help them with their economic position. However, it seems that other parts of the dryland ag supply chain, i.e. the transportation sector, ports, etc., will see significant financial impacts. Is this a fair assessment?
Yeah, I think that's an absolutely fair assessment. And actually, if you look, I've seen some interesting, The Economist, which is the news magazine I tend to follow the closest. They did a pretty good article looking at transportation costs and disruptions associated with the whole getting the product from where it's produced to where it's going to be sold ultimately. There's a lot of disruptions occurring right now, and a lot of people involved in that business, they don't necessarily have a subsidy scheme to cushion them. They're having to work through this as best they can. I mean, one of the things that would really alleviate some of the price pressures we're seeing in terms of inflation is if we could just get the port facilities back to normal operating status, not being disrupted by COVID. That would go a long way in alleviating some of the logistic problems that the non-farm people are having that have to move this product around.
Thanks, Grant. Couple questions, more questions. This one, the labor shortage seemed to be looming prior to the pandemic due impending retirements of baby boomers. It seems like the pandemic just sped up that trend, putting us where we are today. More jobs than workers, even in my very rural community. Do you agree?
Yeah, I can take that. That's absolutely the case. This was basically baked into the demographic structure. So one way that I saw this phrase that I really liked is that the average baby boomer grew up in a family with 4 children and then only had 2 children of their own. So that's kind of a good way to think about the way our demographic structure was shifting. And so obviously labor shortages are going to be baked into that. And it's correct to say that the pandemic sped that up for 2 reasons. One, the pandemic did increase the pace of retirements. There's some preliminary data on this that, maybe something like twice as many people retired last year as in a normal year, and we can understand why this would be the case. The shift to telework, all the uncertainty, plus your 401k was probably really healthy because the market had a great year. So you probably looked, all things considered, and said, I'm out of here. So you do have more retirements, and then there's some exacerbating factors in terms of childcare, concern about catching the virus and other disruptions. So there's a demographic component to the labor shortage that was built in, and then it gets escalated by COVID and all the factors going on there.
Thanks, Sam. And oh, go ahead, Grant. Sorry.
Well, I'll just weigh in very quickly about a specific sector. Because healthcare is clearly pretty important to Eastern Washington in terms of where a lot of job opportunities are, the healthcare sector has been really hammered repeatedly by these COVID waves. And that's definitely a sector where you see a lot of people thinking about either exiting the sector to go work someplace else, or if they can retire, retiring. And so my sense is the healthcare sector is going to continue to struggle to sort of meet, to hire the people they need to meet the demand for healthcare.
And this is a great follow-up. Sam, you mentioned, can you talk, both of you, maybe talk a little bit about the impact of low availability of quality childcare on the labor market? I know our commerce agencies and state government are really trying to raise their focus on this and figure this out, but obviously this is a huge impact.
Sam, you want to take a whack first?
Sure. Yeah, so childcare is always a big constraint on labor force. One of the ways we know this is that COVID impacted female labor force participation more than male. And just statistically, women are more likely to stay home with children. So that's just a statistical reality that we have. So the thing about childcare that makes it really difficult is childcare doesn't scale. There are built-in limitations on it in terms of the ratio of children to workers, how many children you can have in given square footage. So childcare facilities, this is not a business that can scale rapidly to meet rising demand. So it's always going to be a bottleneck on a given area, a given community, just because it doesn't scale rapidly. So this is a sort of perennially problematic issue, I would say, for that reason.
Certainly a constraint. Yeah, thanks.
No, I think Sam, I think that's excellent. Yeah, I think that's absolutely right. And I would also point out, kind of in the near term, when you read about the childcare industry, they're really struggling also to attract people to even conduct their business of doing childcare. I mean, if you're going to attract workers to do childcare, you need to consider now the exposure to COVID, other factors. And again, that probably pushes up wages, not only because you have a tight labor market, but because you need to offer a compensating differential, as we say in economics, for the risks of maybe being exposed to COVID. And again, your business model you may struggle meeting that requirement.
One other thing I would add is that childcare always struggles with labor because the type of people that are going to be attracted to work with children, they generally go into teaching because the wages are better, the benefits are better. Let's be honest, the children are a little more rational by the time they're school age. So this is a problem for childcare, is that people that want to work with kids, they're more likely to want to become teachers than to work at daycare facilities. So that's another problem that industry has with growing and scaling.
Yeah, that's interesting. My wife is director at a nonprofit childcare in Moscow, and 99% of our employers are WSU and U of I education majors. So absolutely. Just a couple more quick questions, and I think this is for both of you. As Sam mentioned, the labor market is a seller's market, and this is the first time in a long time this power dynamic has been turned this direction. How long do you expect this to last? Since Idaho ended pandemic unemployment programs early, did that impact availability of labor at any noticeable level?
That's a good question. So I'll answer that last bit first. Idaho's labor force was pretty much back to normal in terms of unemployment claims and such by the time we ended participation in those programs. So it didn't so much change labor availability as it did it was more of a synchronizing the unemployment system with what we were seeing in the numbers. So that's the first thing I'd say about that. Now, in terms of how long the labor shortage will last, part of it is that you are pushing up against demographics. So that's not going to be rectified quickly or easily. There may be some things that you can do at the margins to bring people back into the labor force. We know that we've lost a lot of people out of the labor force due to opioid addiction and pain conditions, things like that. So those are some things that we can do at the margins to alleviate the labor shortage, but you are bumping up against a pretty hard, stubborn demographic problem at the end of the day.
Thanks, Sam.
Yeah. Yeah, I completely agree with Sam. I think he's right. I think the demographic thing puts in the favor of workers in the long term. But I will also say one of the things that could potentially improve the labor situation for certain industries are industries that can develop technologies to replace labor. And I think you will see an acceleration, depending on the industry, of looking at technology that can reduce your labor component. I mean, I think that would be a natural market reaction to this, especially to high wages. I would also point out, there was a lot of consternation about the extended unemployment benefits. The early evidence suggested they really weren't the dominant factor. They were one factor, but not the dominant factor in keeping people out of the labor market. Risk aversion to COVID was a major factor. Childcare was a major factor. Well, they've since done some new research now with states that terminated those extended benefits early. That research focused more on lower paid workers, but it just essentially confirms that really it wasn't necessarily the unemployment benefits that were keeping people out of the labor force. When they terminated them, there was a little bit of an impact on getting people back to work, but it didn't have a very large impact, not like people thought it would, because again, those other factors are at play.
Great, thank you. And one last question. Sam, your graph indicated that entry-level jobs have experienced the most wage growth. How much has the increase in minimum wage in border states affected that trend in Idaho?
Sure. So there's two things that I would say. First off, we don't have any studies that we've done that our department has done about the impact of Washington's minimum wage on the state of Idaho. The second thing that I would say is that in the Spokane Valley, they just opened a new Amazon fulfillment center where they're trying to hire 1,000 people at $17 an hour is the baseline wage. So that's above Washington's minimum wage. So this suggests that there are forces at work here in the market that far exceed the brute force of minimum wage laws, right? The labor shortage is putting more than enough pressure on labor markets to raise wages. So I don't think we need to go out of our way looking for minimum wage culprits, minimum wage laws as culprits to rising wages.
Yeah, I mean, I would agree, and I think the more wage pressure you have, and the higher wages rise, especially for those lower paid workers, the more the distortion from the higher unemployment, the higher minimum wage goes away. But I would say, just kind of since we talked about Amazon, I do want to just sort of remind everybody, the pandemic has highlighted maybe some struggles we're going to have with measuring the recovery. And Amazon, again, is an example of this. The fact that Amazon data isn't necessarily reported at the county level, and that you have now remote workers that may not be counted at the county level, even though they're living in, say, Spokane County, means that, for people like John, Sam, and myself, maybe our business needs to rethink the way we've been surveying this data so that going forward, the data is more accurate. Maybe the old way of surveying isn't going to give us the accuracy we need. So that's a longer term thing to think about.
Yeah. Thank you both. Great questions from our attendees. And again, the presentations will be out on the Inland Northwest Partner website. Let's give a virtual hand of applause for Sam and Grant. So thank you both very much.
Thank you. And I'll just say, Dr. Forsyth was my professor at Eastern, so anytime he likes my answers to the Q&A session, it's like a load off my mind.
Yeah, you've risen above me, Sam. I'll say that. That was a great presentation.
You've got to let go of that, Sam, okay? You've got to let go. Yeah, great. Hey, speaking, this is a great segue before I introduce John Mitchell. This is an exciting new program that our Avista Foundation is engaged in, but this is really something that is driven by the Association of Washington Business Institute. It's called the Washington State Rural Initiative, and it's essentially a remote online workforce training and certificate program, working closely with WSU Extension, and based on a model that was first launched at Utah State University. This is really a way to create some economic opportunity and job training in our remote communities, and certainly a certificated program. So, excuse me, I've got a couple links out there on this slide for you to look at. The way this is rolling out across our Eastern Washington area, the first cohort will be in Stevens Ferry and Pend Oreille County, and that hopes to launch here next month. The second cohort will be in Okanagan, Adams, and Grant County, and that hopes to launch November 1. And then the third cohort, which is still date to be determined, that will include Lincoln and Whitman counties. But again, this is a great opportunity as we talk about what does this remote workforce look like and how can we create opportunities in this new economy for some of these rural communities and their workforce to stay put. Again, it's tied directly to connectivity, obviously. So that is working in parallel with the great efforts of both of our state broadband offices and all of that as well. But this a really exciting new initiative, and I'm pleased that we can be a part of that. And so again, more information on that, go out to those links. And again, maybe we can post this out on the INP website as well. So again, thanks, Sam and Grant. Great stuff. Okay, it's now my pleasure to introduce our keynote speaker for today. Dr. John Mitchell is a familiar friend and now a full-time resident of the Inland Northwest, and someone whom we always look forward to hearing from, obviously. He received a BA degree from Williams College and an MS at University of Oregon. And prior to the U.S. Bancorp chief economist role he played, he was a professor of economics at Boise State University. So currently he's the principal with M&H Economics. So again, here to provide us with the 21-22 regional economic outlook entitled 2 months down, 16 up, and the excitement continues. Please join me in welcoming Dr. John Mitchell.
Thanks, Paul. Thanks, Paul, very much. It's always fun to do stuff with Grant and Sam. We've had a lot of fun over the years. And what a fascinating time. You know, earlier we've seen, Sam called it bizarre. Grant called it unique. It's an amazing time period that we've been through. As mentioned, it was a 2-month recession. None of us have ever been through one of those before. The output recovery is over. We're back. We've made up the losses from an output standpoint, but not from an employment standpoint. You know, record job openings, initial unemployment claims plummeting, soaring house prices. And now, for the first time in a while, we've got inflation worries. We've got more fiscal policy being discussed. You know, it's not finalized yet. Monetary policy is on the cusp of change. And we've seen dramatic changes in spending patterns. During the pandemic, a shift to goods, now a shift back towards services that's been interrupted by the Delta variant. We are in the process of experiments that I'll talk about later, whose outcome is unknown. We're doing some things that we haven't done before, and we don't know how they're going to turn out. We're watching the global spread, of course, of the Delta variant, rising infections, vaccinated versus non-vaccinated, the healthcare crisis in this corner of the world. And we've seen a slowing in the upturn. There's just a lot of stuff a lot of stuff going on. Oops. And it's not changing. Let's try this. Okay, just the standard stuff. If you look at output, and you saw in Sam's slides the dramatic decline in employment and the rebound. Here on the left-hand side is real GDP, real output. You see the declines in the first 2 quarters of 2020, the surge back in the 3rd quarter, and continuing growth since that point in time. So we're now back above where we were sort of pre-pandemic. There's been a lot of volatility on consumption. You can see, and that's of course the largest component of GDP. You see the 2 quarters of declining at a 33.4% rate in the 2nd quarter, the rebound in the 3rd, and continued increases. I mean, that's the big picture. The recovery in output, the volatility on consumption. If we look into the details, okay, the contributions to growth in the 1st and 2nd quarters of this year, what I want you to see is on the left-hand side, you see consumption. What that says is consumption accounted for 7.44 percentage points of the growth rate in the 1st quarter, 7.8 in the 2nd quarter. You look at the 2nd quarter and look at the jump in services. Remember, early on in the recession, in the pandemic, we were spending dramatic increases in goods spending. Then in the 2nd quarter, you saw services, of course, start to come back. And there's been some evidence of slowing of that recently. And then we've got the investment component, housing. Housing's very, very strong. It slowed in the 2nd quarter. You got supply chain issues. There's a backlog of permits waiting to be started. I mean, inventories have been drawn down, okay? But the driving force, though, has been that rebound in consumer spending. Well, okay, let's talk about employment. We've heard about employment in the region. If you step back, look at the national data on the left-hand side, you see the monthly changes, and you see that huge decline in March and April. And that's what showed up on Sam's graph with that big drop, and then the rebound ever since that point in time. Now, the only down month was December. And if you'll remember, we had another surge in infections, more closures and restrictions, and you had a decline in employment in December, and then starting it up again in January, and it's continued. Now, the August number got a lot of people's attention. It was expected to be significantly larger, up in the order of 750,000, and it came in at only 235,000 net gain. Unemployment rate dropped to 5.2%. But let's look a little bit behind this. You got 5.7 million people supposedly not in the labor force. They're not looking for work, but they want a job. And 4.5 million people part-time for economic reasons. They'd like to be full-time, but they can't find it. The participation rate, the fraction of the population in the labor force at 61.7 in August. Back before the pandemic, it was 63.3. That's about 4.1 million more people if the participation rate was the same. 10.1 million, that's since gone up to 10.9 million job vacancies, but we're still 5.3 million below where we were in February of 2020. So you see the rebound, but clearly it's not all the way back in the labor market. Now, the 235,000 got people very, very excited. Oftentimes what was lost is there were upward revisions to June and July, and the number that we saw in August will be revised. Re-entrance to the labor force increased in the month of August by 200,000. You know, not in the labor force, but currently want a job, fell by 835,000. So there's some things in there suggesting continued strength. People who were marginally attached to the labor force, not counted as unemployed, they had not looked for work in the month, that fell by 295,000. So it's shifting. Leisure and hospitality was unchanged in August. For the previous 6 months, it had gone up by an average of 350,000 a month. But you'll remember in August is when the Delta variant got going and started to have more impact. And that sector, 1.7 million below where it was in February 2020. You know, that's a significant part of the shortfall. We've talked about Amazon a little bit this morning. Transportation and warehousing up 53,000 during the month of August. 13.4% of employed persons had teleworked in the past 4 weeks. That number actually went up in August. So there's a lot of stuff going on. Remember that when we look at that unemployment rate and see those job counts, that's a snapshot at a point in time. There's a lot of churn going on. People entering, leaving the labor force, a lot of stuff happening behind that number. Average hourly earnings rising, and as been shown earlier, you've seen rapid increases at the lower level of earnings. Now, think about this environment. As was mentioned earlier, we haven't seen tight labor markets like this for a very long time. You probably really have to go back in the long sweep back to the mid and late 1960s. These ubiquitous help wanted signs, at the same time, you know, a shortfall in jobs. I mean, lots of people unemployed. A lot of things you can look at. The closed schools, that's been mentioned earlier. In some reading I was doing the other day, there was an interesting argument, dramatic increase in homeschooling, which would potentially be expected to take a person necessarily out of the paid labor force. The daycare issue has been addressed earlier. Those things are likely involved. On old boomers, there's some new data that says that you didn't really see a dramatic acceleration in old boomers retiring, but what you saw was a decline in reentry. I mean, as I said, it's a process. People go out of the labor force, people go back into the labor force. And there's been a dramatic slowing in baby boomers going back in. And part of that may be related to the fact that, you know, the stock market and stuff has done well. Maybe it's fear. I couldn't help be thinking about this when Grant mentioned the importance of familiarity with Microsoft Office. Some of the old boomers may not be at the cutting edge of technology. That may be playing a role. But there's an interesting question is, will they be back? And that's obviously got regional implications when Sam talked about the dramatic influx of people over 65 into the region. They may not be in the labor force, but will they enter or re-enter? Fear, fear of the virus. Some argue there's a prioritization. Been stuck around the house for 18 months, and you say, well, Do I really want to go back into the labor force? Are other things in life more important? You're driven to reflect on that stuff by virtue of the pandemic. The structural change, we've seen the dramatic decline in leisure and hospitality, increase in transportation and warehousing. You've got changes. It's going to take time for people to change, to pick up new skills, change locations. We don't adapt instantly. The immigration decline. We've had changes at the border, a decline in immigration in the United States. That's probably played a role in some of the shortfalls of employment. One of the things I think is interesting to think about. Let's go back in time to February of 2020. If you were to look at the beige book at that time that comes out from the Fed, what were we talking about? Shortages of labor, rising wage pressures at entry level. We're back to that. We had an interruption, but now we're back. And this may well be for the long haul. I mean, the demographics argue we're seeing slower growth in the labor force. From a policy standpoint, there seems to be a bias I'll talk about later to pushing policy to tighten the labor market. So this may be a condition for a long time. I was fascinated by the quit rate, and this has been shown earlier. Look what happened to the quit rate. Went down during the recession and then increased sharply. You do that when you have options. More broadly, the labor force participation rate. You see the decline, and it's come part way back. What we don't know is, will it come further back? Will it get back up closer to that 63.3%? Okay, only time will tell. From an inflation standpoint, and this is sort of interesting if you're an old economist, because I can remember back, and some of you on the call can remember back in the late 60s, the 70s, the late 70s, where inflation was a huge issue. We were talking about double-digit inflation rates in the United States. Well, now it's back being talked about a lot. I've got the consumer price index on the left-hand side. You can see the run-up. Look back at April, May, June of last year. The year-over-year increase in the consumer price index was well below 1%. That was at the depths of the downturn, and you saw dramatic declines in airfares and energy prices, etc. So we had very low inflation. Now you knew, over time that was going to come back. Now, August of 2021, consumer price index was up 5.3%. The core, which excludes food and energy, was up 4%. The personal, the personal consumption expenditure index, 4.2, with the core at 3.6. If you think about what inflation is, an ongoing increase in the general price level. It is not the run up in one price 1 month. It's an ongoing increase in the general price level. Now, the Fed has had a target since 2012 of about a 2% increase in the personal consumption expenditures index. That's their target. Well, for a long time, they didn't achieve that target. Well, clearly at the present time, we're running well above that. Okay. Now, let's think about this. When you get 1 year past the depth of the downturn, April, May, June last year, and prices have returned somewhat to normal, you're going to get a jump in the measured inflation rate. And we have seen that happen. Everybody knew that was coming, okay? But there's more to it. If you look at the changes in people's spending patterns, we shifted from services to stuff where we were stuck at home, whether it was bicycles, Pelotons, home improvement, furniture, home electronics. We shifted away from restaurant meals, travel, hotels. Now, to some extent, it's shifting back. Now, it's been interrupted by the Delta variant, but the pattern has started to change. You had demand shocks to people that were in the construction business or people that made bicycles or furniture or electronics. Okay. Demand surprises that help put upward pressure on prices. Now we've got the COVID disrupted supply chains, okay? Whether it's people to unload containers in Los Angeles and Long Beach or load them in China, we've disrupted supply chains. Now, we always have shocks, but it's been fascinating to look at the shocks this time. I suspect if we went back a year and we said, okay, let's name container ships, most of us probably couldn't do one. But now we know about Ever Given. That's the container ship that got stuck in the Suez Canal. The poor harvest. Grant talked about what was going on in the wheat business by virtue of the drought. The frost in South America impacting coffee. The Texas storms. Remember that winter storm that hit Texas with disruption in their power grid, but also took petrochemical plants offline, impeding the flow of plastics and components that comes from that. The COVID in Malaysia, okay, where they do a lot of finish work on chips. The chip plant fire in Japan. The partial closure of the port of Ningbo in China, the transportation bottlenecks that have been alluded to, Ida a couple of weeks ago, and suddenly we take significant portions of U.S. Gulf oil and gas production offline. These shocks have come at a time, and they've put that we've had danger on the inflation front, and they've put at least temporary upward pressure on the price level. Now, the big question is this transitory? How much of this is related to the reopening of the economy? Things that will be resolved as the supply chains get straightened out, rather than the start of an ongoing increase in inflationary pressure. This is a critical question for the Federal Reserve and for interest rates going forward. Now, I went back and sort of looked at some of the older data. The last time annual inflation was over 5% over the course of a year in the United States was 1990. That's probably not in the memory of much of the population, where an older generation can remember the double-digit inflation rate in the United States that was like public enemy number one. But now it started to rise on the concern list at the moment. Now, the August Consumer Price Index, it slowed Okay, it was the lowest monthly gain since February. So some people thought, well, okay, that's consistent with the transitory notion. We'll have to watch. Chairman Powell on August 27th at the Jackson Hole Conference talked about inflation. The spike is largely the product of a relatively narrow group of goods and services directly affected by the pandemic and the reopening of the economy. You know, you saw the surge in used car prices, for example, hotel rates, airfares, you know, very much impacted by the reopening, the chip shortage, a narrow sector of goods. Expectations are key. Long-term expectations of inflation, okay, have moved less than actual inflation or short-term expectations. And that's all consistent with the transitory view of the price shock. You know, I put a slide in here from the Federal Reserve Bank of Atlanta where they track wage growth. And you can see, if you look at that wage growth, 3-month moving average, median wage growth, you've seen on the right-hand side, okay, the lower bar, the darker blue, is the overall wage level, and it's jumped a bit, up close to 4%. The brown is for people who switch jobs, and that's interesting because the tight labor market opens up options, and you can see that job switchers had a faster growth in earnings, which is what we would expect. So you've seen a tightening in the labor market. You've seen an upshift in wage growth rates. We'll have to see where that goes, how long that will last. And the important question from an inflation standpoint is how much is offset by productivity gains. If we look at monetary policy, remember what the Federal Reserve is doing. Now, when we did this event last year, some of you might remember the Fed had cut rates down essentially to zero to 0.25% on the federal funds rate. They did that in the spring, right as the pandemic got going. They did it in March. Okay. They started buying securities. They're buying $120 billion per month of Treasury securities and mortgage-backed securities. They're continuing to do that. On August 27th, in August of 2020, at the Jackson Hole Conference, they announced a new operating policy. Now, I talked about this last year, but that new operating policy called FATE, Flexible Average Inflation Targeting, is that they will tolerate inflation above 2% after a period of below target inflation. Now, remember, we looked at that inflation numbers a few minutes ago. Inflation is well above their target now. Okay, the question becomes, how long will they tolerate it? The most recent rate projections from the Fed, and we'll get some more next week, is rates will stay down in this range until 2023. Okay, remember, they've got rates down essentially at zero, and the federal funds rate 0 to a quarter. Now, we've got this fascinating situation now. Okay, interest rates, you know, the 10-year Treasury is about 1 point, I don't know where it is this morning, but it's about 1.3%. Okay, inflation, okay, is running 5.3%. You know, the interest rate is below the inflation rate. So, you know, you're losing on that transaction. If you have an interest rate on an earning asset or a U.S. government bond, it's paying 1.3%, inflation 5.3%. It's eroding the real value. That's called financial repression. That may be how we deal with the debt. Okay. On the right-hand side, I showed the 10-year Treasury. You can see the plunge that it went through in 2020, rose in early 2021, and then came partway back down, but it remains well below where it was back in 2019. What the Fed said at its last meeting in July, they decided to keep the target range for the federal funds rate. They think they're going to maintain this. Now, note this phrase, until labor market conditions have reached levels consistent with the committee's assessment of maximum employment and inflation has risen to 2% is on track to moderately exceed that for some time. That's what they said in July, was reaffirmed on the 27th of August. The decision they're facing is when to begin to slow the asset purchases. Fed Governor Brainerd said it will depend importantly on the accumulation of evidence of substantial further progress on employment. That was said at the end of July. So you can see why that slowdown in the August employment is important. Coming soon, maybe the taper. Chairman Powell said they're going to start reducing the pace of asset purchases this year, that $120 billion a month. It's very careful to say that is not intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. Okay. The Fed, or Chairman Powell, said they would not attempt to offset temporary fluctuations in inflation. See, the Fed believes that's what we're seeing. They're not going to try to offset that by changing interest rates. The shock of those August numbers and the softening in the data from the COVID resurgence implies delay, okay, I think, in the taper. I believe it'll start this year, but it might be November or December. Watch what they say next week. The Beige Book, which is the compendium of anecdotes that comes out before the Fed meets, was interesting. If you read the last Beige Book, it's pointed to moderating growth, the impact of the Delta variant, and elevated price pressures. They're still out there. Okay. So that's the environment that we're in. From a fiscal policy standpoint, okay, here we're talking about taxing and spending federal level. Since last year, we had, of course, the $900 billion program right at the end of last year. Then earlier this spring, the American Rescue Plan, more stimmies, funds for state and local governments, rental assistance. You've all seen that list. We've got an infrastructure plan passed the Senate, in the House, vote by end of September. The $3.5 trillion budget resolution that passed the House, so a budget resolution that they could do in the Senate without any Republican support. But the details, they're becoming clearer. Okay. Some of the things that were going to be included: paid family leave, child care, extension of tax credits, expanded Medicare, dental, hearing, vision, and lower the age. Those were things that were talked about, that were planned. Okay. Universal pre-K, tuition-free community college, rebates for clean energy, green energy tax incentives. There was no increase in the federal debt ceiling, which is going to have to be dealt with, a variety of tax increases. Okay, this thing isn't finalized yet. It's still being negotiated at this point in time. But what's interesting, this is a major expansion of government and entitlements, very much reminiscent of the 1960s. Okay, so it's going to be interesting to watch what happens. Now, one of the interesting things about this particular upturn in fiscal policy was the way it cushioned income. Now, a lot of you probably saw headlines yesterday that said median family income went down in 2020. Now, when I got up yesterday and opened the newspaper, I go, what? That can't be. But then you read the fine print and they excluded the stimmies. They didn't count the stimulus income, which of course was potentially thousands of dollars. All right, here's changes in personal income. I've got Idaho at the top, the first quarter of 2020 rising at an annual rate, okay, of 6.9%. The second quarter, now remember, this is the quarter where on Sam's graph you saw that huge decline in employment. Personal income rose at an annual rate of 42.3%. Earnings went down, but look what happened to transfer payments. They rose at a 688.2% annual rate. In the third quarter, it went down. Fourth quarter, because earnings came back, but transfers went down. Then the first quarter of this year, we saw another surge in income. Earnings were up, but look at transfers. Similarly with Washington, okay, you saw income supported by the transfer payments. Like in Washington last year, personal income was up 6.6%. Transfers were up 36.6%. Idaho personal income up 8.1%. So this was a fascinating use of fiscal policy to support income, okay, during the downturn. This is not something any of us have really seen before in the United States. It was a dramatic use of fiscal policy to support income, okay, and cushion the downturn. Now, if we look at 2021, the expectation was, if we go back a few months, this was gonna be, okay, a very strong year. The vaccine distribution and effectiveness, the fiscal stimulus, the monetary policy support, low levels of inventories that would have to be reduced, or that would have to be increased, schools reopening, more face-to-face contact, people would not have to stay home to take care of the kids, the balance sheets of consumers strengthened, net worth continued to rise, credit quality improved. There was a lot of excitement about a return to some semblance of normal. Okay, now it's sort of fading a little bit with the spread of the Delta variant. Watch the current wave. Some of the high frequency data, whether we're talking about restaurant reservations, TSA counts, airline reservations, they show some softening. You've seen delays in return to the office programs. How long, how much, we don't know. You've seen downward revisions to the outlook for the year as the Delta virus spreads. Not a return to recession, but rather a little bit slower than had been expected. I mean, the fall 2020 virus is simultaneously growth slowing and price raising because of the distortions to the supply chain. Sort of interesting to think about. Now, I'll say a little more about housing that was addressed. Sam addressed it earlier. It's been a perfect storm for sellers. Low levels of inventory, strong demand, mortgage rates for much of last year, they were under 3%. Preferences, all of a sudden, we better have a bigger house or add a room that could be used as a classroom or an office. The demographics, millennials in the home buying demographic, various pandemic distortions from the inability to increase supply, closed planning departments, that sort of thing last spring. You got supply chain issues for appliances, for copper piping, lots of shortages, things distorted in part by the pandemic or the storms. One of the fascinating things, if you look at the Federal Housing Finance Agency purchase only house price index, every single state had rising prices. Now, these are the prices of the same homes as they are sold, and they track them over time. So it's a paired index, okay? And this is purchase only. The mortgages purchased by Fannie and Freddie. Now, what's interesting, Idaho had the highest appreciation in the country, 37%. Utah was number 2, Washington number 8, Oregon 10th, Alaska was 50th. Alaska was last, and house prices were still going up by 8%. Now, when you see those kinds of rates of increase, okay, there's an affordability constraint out there. Okay. Last year, okay, we had dramatic declines in interest rates, rising income, and rising prices. Well, housing affordability held up pretty well, but rates have leveled off, prices have continued to rise. The National Association of Realtors, the affordability index, has dropped from 171 in 2020 to 151.8 in the second quarter of this year. So housing affordability is starting to become a constraint. Okay, you've seen some weakening in prices in some areas. The strength in housing is anticipated to continue from a production standpoint because of the demographic issues, okay, and the lessening of supply chains, and there's going to be emphasis on providing housing. Now, I thought there's some fun pricing stuff. Okay, the Federal Housing Finance Agency data for metropolitan areas came out, and this is all transactions, not just purchase only. But what was interesting from the standpoint of this group, the first 3, Coeur d'Alene was number 1 in the country in the first quarter. Boise was number 2. Idaho Falls was number 3. Spokane was 10th. Tri-Cities 42nd, Yakima 74th, Wenatchee 71st. But it was, what I thought was fascinating was the Idaho at the top of the list, the first three places. Looking at the Washington Center for Real Estate Research data for the second quarter, going some of the counties, you look at Whitman County, it was talked about earlier. Median house prices up, sold up 21.3. Adams County 24. Garfield at 0.9%. Grant County at 21%. You're seeing broad-based pressures on housing. Now, one of the things I like to do is I love to use job growth. Job growth update goes out of the Arizona State Bureau of Labor Statistics. And what's interesting, and this relates in part to the graph that the chart that Sam had up, this is year over year employment change. Okay, in July, all 50 states were up on a year-over-year basis. Note number one was Hawaii. Idaho was 18th, Washington was 13th. Now, if we were to go back prior to March, okay, Idaho and Utah were the only states that were up on a year-over-year basis. 48 states were down. But now everybody's growing on a year-over-year basis, okay? Idaho's no longer at the top of the list, but it's in a very different place because it's already recovered, okay? So you can see we've got broad-based growth across the country now, okay? And that's an important point. You can see Oregon, and the other Northwest state hanging in there at 30th. Now, one of the ways I like to look at this, rather than getting a horde of graphs, is February 2020. Let's call it 100. That was the last month before the pandemic. Look at that left-hand graph. February is 100. Okay, I don't have February on there. By April, okay, Idaho was down to about 89% of February. Then look at the recovery, and then you see Idaho went back over 100. Idaho recovered. Sam showed that earlier. Okay, in the year to July, which is the most recent data, Idaho employment up 5.6%. You can see broad-based. You can see that our leisure and hospitality snapping back. Okay, but Idaho up 5.6% over the time period. Now, there's track the recovery is a new source of data. It comes out of Harvard, Brown University, the Gates Foundation. Lots of interesting research on state and local areas that you can track a variety of data. Okay. On the left-hand side, this is sort of interesting stuff. Tracking changes in consumer spending relative to January of 2020, right before the pandemic. Grocery spending in Idaho up about 27.3, total spending up 21.9, restaurants and hotels up 18.5. That's an indicator of the rebound in Idaho. Percent change in employment relative to January 2020, their numbers show an increase of 18.3%, low wage employment down. It makes the point that low wage employment has tended to bear the brunt of the impact of the employment weakness during the downturn. The data source on the consumer spending stuff is credit and debit card transactions. That's what they're using. They're anonymous, and they use those to try to get a high frequency indicator of the spending. Let's look at Washington. Okay. Again, February was 100. By April, Washington was down to a touch over 88. And you can see it's coming back, but it's not all the way back. It's at about 97%. Year over year, employment security up 5.9%. It's coming back. This is a pattern that you see across much of the country. And just like Sam said, there were just four states that had had regained all their jobs. Idaho's one of them. Washington is not, but it's coming. It's coming back. Here's the track the recovery data for Washington. sort of interesting. This is as of August 15th, okay? And you can see the big jump in grocery store spending, 16.6 in total spending, 3% in restaurants and hotels. That looks very different than the Idaho set of numbers, which had more dramatic strength in restaurants and hotels. From an employment perspective, okay, again, you see the hit. This is data as of June in Washington. You see the hit at the lower wages. Okay, that's where the employment weakness was concentrated. But you have a picture, across the country. We're growing, we're coming back. A few states are there, but we're not there. We're not there yet. I talked about grand experiments earlier, and I think we have to sort of think about this. Modern monetary theory: spend what you need in order to achieve your goals, tighten when pressed capacity. Shorthand, but look, nobody seems to be very much concerned about levels of federal spending, deficits, that sort of thing. We've had rapid increases in spending that are likely to, at least in the present legislation, to continue. Okay. Theoretically, we would tighten when we press capacity. We'll have to see. What I'm interested in, especially this week, you see proposals now, change the tax rates, altered structures. What are going to be the behavioral and performance impact of this? Okay, increasing taxes on high-income people, increasing business taxes. Well, from a business tax standpoint, I think most economists would agree businesses don't pay taxes. They collect them. They collect them from their customers, they collect them from their owners, or they collect them from their employees. So we'll have to see how this is going to play out. There's been a change in the regulatory environment. Okay. We went through a period of relatively reduced regulation. We're seeing it move the other direction. We have never operated with this flexible average inflation target. How high and how long will inflation be allowed to run above target? We don't know. We've never done it. And then sort of how are we going to deal with the debt? Is it a big problem? Is it no problem? Or is it a manageable problem? Okay. We're going to find out. So the outlook, okay, where are we going? The expectations, 2021, 5 to 6% growth in GDP. That's moved down a bit. Rates and inflation higher, 3.5 to 4% in the CPI, continued increases. 2022, growing but slower. Inflation lower if the transitory elements fade. That's the if. Idaho and Washington, both expected to continue to grow. Okay. Washington, 2% in 2021, 3.7 2022. Idaho, 4.5 this year, 3% next year, continuing to grow. Okay. That's the bottom line. But there's a high level of uncertainty. We don't know what the full course of the virus is going to be. We don't know what policies are going to be. They're still unclear. Now, in sort of a quiet moment, there's been lots of quiet moments over the last year, reflecting on what's going on. It's a fascinating article in the July August issue of Foreign Affairs. The forever virus. We may have to face the fact we're going to be living with this for the rest of our lives. New variants are mutating in the world's unvaccinated and spreading across the planet. There's a new variant, the MU variant. I mean, we may be every year, like, we're accustomed to going to the pharmacy or whatever and getting our flu shot. Well, there may be adding something to that, or we may be getting our virus shot as new variants appear. I mean, I think we may have to move beyond thinking of this as a temporary situation. The vaccine progress, it's very upsetting to look at the conflicts, the divides, what's going to happen for kids under 12. How is this going to play out? Okay. The behavior of actors. We're all actors. We're consumers. We wear a variety of hats: consumers, investors, business decision makers, a myriad of roles. How are we going to respond to this environment? Will we continue to eat out like we did, or will we be eating home? Our retail patterns. How will we invest? The demand surprises were the fascinating things over the course of the last year or year and a half is the demand surprises. Did home builders expect when this started that the demand for homes would soar? Probably not. Automobile manufacturers, they canceled chip orders because they figured with the pandemic, the demand for autos would decline. Wrong, went the other way. Okay. Bike manufacturers probably didn't expect that last year. All of the demand surprises that we experienced last year for hotels and airlines, that wasn't what they expected. How will we adjust to those? Will the labor supply increase? I'm very excited about watching the end of this year with schools back in session, with the increased vaccinations, maybe some resolution of the immigration. Will the labor supply increase? Will baby boomers come back into the labor force like they were before? We are watching the flexibility of a market system responding to an altered environment. The environment has changed, demands have shifted, and we're testing the flexibility, the resiliency of our system. Grant mentioned some businesses will not be viable in the current environment. People will redeploy their capital, labor will do something else. But it's a world with lots of options at the moment. One of the phrases I love is creative destruction. It comes from Joseph Schumpeter. New ways of doing things replace old. Well, one of the interesting things, and this is from Census Bureau data, look what's happened in Idaho and Washington, okay, to new business applications. I mean, the world is changing, and we've seen an acceleration in new business applications. I don't know what they all are, but trying different things, new startups. That's part of that adjustment process to the new world that we're going to be in. Now, I want to end on a note, if things go right. It's very easy to get down. I mean, I've almost afraid to watch the news when we talk about, crisis care in the region, and infections and death rates and rising inflation. It can get in Afghanistan. It's very, very depressing. But I'm basically an optimist at heart. What if things go right? What I mean by that, inflation is transitory. that we go out 6 months, supply chains have straightened out, you're seeing less pressure, okay, and inflation goes back down. If tapering is a non-event, when it starts later this year, hopefully it will not be a taper tantrum as we saw earlier in the decade. If supply chains straighten out, okay, and deal with the distortions, if business investment strengthens, the funds are there, the capacity to borrow is there. Business investment is a great hope to increase productivity. Grant talked about people are going to have to find different ways of doing things, substitute equipment for labor. Well, that's going to require business investment. If productivity accelerates, okay, the new ways of doing things boost productivity. Productivity's already accelerated because look, we're back up to output like we were before, all right? But we're still shy on employment. Then by definition, productivity's accelerated, okay? The tight labor markets bring opportunity and participation for those who've been disadvantaged, who've made youthful mistakes. I mean, that's a very positive possibility, okay? I mean, those things could come to pass and we would not have a replay of the 60s and 70s with the accelerating inflation, but we keep the strong investment, the tight labor markets and their opportunities. I mean, that could happen. It's too early to say whether it will, but it could. Thank you very much for your attention.
Thank you, John. We've got a couple questions. I'll tee those up for you. One has to do with something you addressed a little bit. Based on the emergence of the Mu variant of COVID, it seems likely that we will be in another COVID-19 wave immediately following the Delta variant. Are we seeing economic impacts related to the COVID-19 related deaths, say in a 1 in 500 people dying?
I guess, well, we're seeing the impact of the Delta variant now in the slowing. I think it's too early about the new variant, and we don't know necessarily the vaccine effectiveness against that. That's why I said this is likely to be an ongoing process. There may be waves like we've seen before, then they'll diminish, then a new variant will come along, and that's why I say we'll have to live with this over the long haul. But it's going to be a constant risk, and it makes the point. This is a global issue that it's going to put new emphasis on coordination of vaccine programs and distribution, because if it mutates over elsewhere in the world amongst the unvaccinated, it'll ultimately get here.
Thanks, John. This is a question, and our attendee writes, from the Track the Change data, how much of the loss in job growth in lower wage positions are a result of a tighter labor market and people increasing wages?
All right, could you repeat? Wait, how much of the
loss in job growth in lower wage positions are a result of a tighter labor market and increasing wages?
Oh, okay. If that labor market data, that's compared to January, those lower wages have the lower wage employment is lower. Some of those people may well have moved to higher wage positions. Yeah.
Thanks.
I think that very likely. That's why when you see so much of that shortfall, 1.7 million jobs is in leisure and hospitality. Well, those people, they may not want to go back there. They may be working in a warehouse at a substantially higher wage with benefits.
Right. Good. Thanks. This one is talking about the infrastructure package. Can you talk a bit more about the potential impacts of the federal 1 trillion bipartisan infrastructure package and the 3.5 trillion partisan package?
Well, I mean, one of the interesting things is, okay, you've got this infrastructure package, and there's no argument that you could use more investment in the physical infrastructure, but what's going to be the timing? I think back in 2008-9, the notion of shovel-ready things that didn't work very well. The big question is how long, what kind of spending is going to take place over what time period, and then I think you have to ask, based on what we've done this morning, where are the people going to come from?
Right.
I mean, you don't see a lot of unemployed construction workers. Okay, and I think there's some real supply constraints there. The broader package, the $3.5 trillion package over a decade, I mean, that's a fundamental expansion in entitlements. Okay, and there are some real funding questions there. Again, how will people behave? Some of it clearly, when the tuition-free stuff may increase college enrollments, increase skill levels, but that would pay off over a long period of time. And I think there's a question, given the pressure on the price level now, and the tendency, of course, in the past has been to underestimate the cost of those programs. Is there a threat from an inflation standpoint? One of the sort of interesting things to do, go back and read a history of the 1960s, okay, where we had low inflation and the idea we're going to dramatically change the social safety net, which we did, and increase spending. Of course, there you had a war on top of the Great Society programs, and that culminated later in significant increases in inflation that had to be dealt with in the late 70s. Hopefully that's not going to happen.
Yeah, well, thank you. Any other final questions? Well, John, on behalf of the Inland Northwest Partners, as always, thank you for great information. And I appreciate the fact that we are in a very fluid economic time, and we're not sure where we're headed, but you obviously provided a lot of great context for us. So thank you very much, Grant and Sam. Well done as well. Just want to remind you all these slides are available on the Inland Northwest Partner website, www.inwp.org. Shortly, we're going to be sending you a link for a survey that will pop up, and we'd really, really appreciate you taking a few minutes and completing that evaluation. It helps us shape future meetings of the INP, and hopefully those will be in person, but we are trying to be as flexible as we can. And if we need to come back in a virtual meeting, we will, absolutely. But we'd like to hear from you all and give us your ideas on topics and focus areas. Really appreciate that. And finally, I want to thank University of Idaho Extension, Colette and Mackenzie. You guys are rock stars in supporting our technology. Thank you so much. So with that, I am going to call this meeting adjourned, and thank everybody. Continue appreciating your support, and have a great day.